Hey everyone, this is Jose. We are about to get started. Just a few seconds to go, less than a minute. As always, it's a good time to do a sound check, a quick message on the chat box. Just type hello. It's nice for everyone. And now I know you hear me. So let's do the sound check this way, if that's okay. And we're starting in 30 seconds. Thank you so much. Ten seconds to go. Almost there. Thank you. Thank you, everyone, for those confirmations. This is great. Today is October 27, 2022. My name is Jose Blasco. This is Options Trading Live. We're gonna basically trade options. We're gonna look at the options markets. We're gonna look at equities as well and understand market environment and get ready to trade options. Before we get started, how are you, Mark? I would like to highlight the financial disclaimer on the upper left side of your screen. It's being highlighted. Please read it carefully what is being highlighted. It is important information, and since it is fairly short, I always make the point that it's fair for me to request that you guys read it completely, because again, it's important stuff. Okay, thank you so much. So let's get started. And the agenda, it's going to be to look at the market environment. We will also be looking at the trades that we have running and talk about trade management. And from there, we will look at trade execution, looking for new opportunities. Wonderful. Hey, yes, Jeff, good to see you. Perfect. Okay, so market analysis. Let's begin. I'm going to load the VIX first of all. And obviously, probably you are all aware that the VIX has been dropping from the 30 pluses to 27, which it's funny because, low can be 22 and even lower, it could be 20. And, it's like, it feels like 27 is quite low, given the fact that, like a year ago, 2 years ago, definition of low for the VIX was much lower. Okay, but certainly we went down by a lot, and the only reason why I'm not going to say it's too low, it's certainly not high, but the only reason why I'm gonna suggest that it's not that low is because the next UFO is all the way located at 23.9 square 24, and there's nothing in between to stop the VIX from keep going lower. So I would like to consider the VIX to be more or less in the middle. And being more or less in the middle, to be honest, this opens the door for me to look for either options buying opportunities as well as options selling opportunities. I'm okay to do any of those. And therefore, I'm going to be super flexible today when it comes to the type of trades that we find, because it's not like we're high or low on the VIX. I'm calling it in the middle, and therefore we can do both. The good news is that being able to do both, normally you find more opportunities. The bad news is that being in the middle, and because you can do both, you have more opportunities and therefore probably less extreme situations. And we like extremes, isn't it? Because extremes normally imply higher quality probability, higher quality opportunity, and also often higher probability as well. Okay, so everything comes with a trade-off in life and in trading, and this is what the VIX has to offer today. So then we switch to the S&P. And we're going to do our market analysis now. I see Joanne is with us too as well. How are you, Joanne? Yeah. Yes. Perfect. And by the way, Joanne, you are typing it on the chat box. If you don't mind, I will just, since I have the microphone, I will just mention it as well. So as you guys know, probably, but just in case you don't, let me open a browser. So I'm going to bring our website. Just 1 second, guys. Here, I'm just just loading the website on my other computer screen, so I can bring it here. Okay, so just bringing our website right here. Okay, so as you probably know, or many of you should know, when you scroll down all the way to the bottom of our website, there is a section here which is the traders meetings. Okay, and when you click in here, you come to a page where you have to log in first, okay? So, which, by the way, to log in, you just need to have a free sign up on the website. If you don't have it, if you're watching this recorded, so you just need to have the free sign up that gives you a username on the website, and with that, you can enter the meetings room, which is right here. So the meetings room is a place for you guys to meet, to share screen, to record the screen if you'd like, to not to record if you don't like, to use the microphones, to use the chat box, to do whatever you'd like, to plan threads together, to collaborate, to communicate. And Joanne has an idea there on the chat box for you guys to get together and meet and talk. Okay, so make sure you guys using the chat box, share, your email address, things of this sort, or you just discuss it right now, real time, if you're connected live, which are the days or the times that is good for you to meet. So that way, you have an easy way to communicate and meet on the traders meeting room and just work on your trades, work on, how to use the platforms, work on your trading plans, keeping each other accountable, you name it. Okay. Anyway, Joanne, I guess this is the essence of your message. But if there is anything else you'd like to add, feel free to type it, and also I'll be happy to read it as well. So for the ones watching this recorded, they can also understand, because the chat is only visible to the live attendees, not the recording one. So yeah. Anyway, wonderful. So the S&P, right? So we know the VIX is more or less in the middle of nowhere. What is going on with the S&P? Well, the S&P, my friends, okay, and it's been a long time for me to be able to confirm this. The S&P is in an up climate, which is confirmed. Look at the thick dot. It's confirmed since 3 days ago. We haven't had a confirmed up climate until that date back in the past, but at that time, if you recall, the gray line was above the blue, meaning the implied volatility for the puts was above the implied volatility of the calls, meaning that we had sellers in the marketplace. Even though the market was trying to go up, sellers were in the marketplace in the options market. And guess what? From there, we had this very pronounced, very strong down climate. So what's the difference now? Well, the difference now is that we do have an up climate, but this comes with a blue line above the gray line, which means that in the options markets, we have identified buyers. So in other words, there are buyers in the market, and the market is proving itself by going up and defining a blue climate. And therefore, it's been a long time I haven't said this, but today my goal is going to be to find buying opportunities, okay? Look for stocks that are good candidates for us to be buyers. And because volatility is in the middle of nowhere, it's not high, it's not low, I'll be happy to do debit spreads, credit spreads, ratio spreads, whatever that makes me directional, as long as I find good candidates for this type of trades. Okay, so it should be fun. And normally directional trading is a bit simpler than non-directional, so we should be able to move quickly. Cool. So Joanne is suggesting Monday anytime for those meetup gatherings. So you guys feel free to throw a few times out there. Anyway, so positions. So we now understand what's the market condition. Let's talk about the trades that we have in. So the last trade that we commented on our last session was Nucor. Okay, Nucor right here. Okay, so this is Nucor. The last expiration date was October 21st. So this trade is over. So I don't have anything to review here, and we talked about it last week. So I'm just gonna delete this multiple week trade with Nucor. And the next one in the list, as you can see, is Amazon, which Amazon is a trade that we still have running. If I was to, by the way, this trade concludes tomorrow, October 28. By the way, talking about Amazon, earnings on Amazon, okay, are happening after the market closes. Okay, so we have here the E for earning, and it says after market close. Okay, so it's happening today after market close, and the expectation would be, a big move. I mean, this is a stock that normally moves quite big. So we're gonna have to see what is it that in the end happens. But in order for us to decide if we want to stay or not, so then the idea would be to look at where are we at, right? And if we look at where are we at, and I look at the risk graph, of the current position we have. Okay, we are here. Okay, we are here in a place where we are currently making $149 net per contract. Worst case would be down here, which would be to make 73. Max risk negative 73 means that you cannot lose money. The worst case is to make 73. So this trade is a sure thing profit of minimum 73. Okay, but again, since earnings have not been reported yet, there is still plenty of implied volatility. The theoretical value of the option should be up here, but the real value, the real P&L of the trade is still down here. And that's because this slowing down effect on time decay, because there is still plenty of implied volatility in the option, given the fact that earnings are happening after hours. So in order to realize the full profit of 173, we need to leave the trade open. And the risk for that will be that Amazon gaps up. And next thing you know, tomorrow Amazon is trading, above, 120 something. And next thing you know, you are making $73 instead of making $173. So since we cannot lose money on this trade, it's very simple to me. It's a no-brainer. We just leave it open and that's it. And let's shoot for the maximum profit. But of course, for some of you that may be more conservative, maybe you want to plan on closing the trade, okay? Careful though, because you may have a little bit of wider spreads, especially today. So if you're going to do it today, just make sure you do it soon. Don't do it close to the ending time of the day. Don't do it close to the closing time, because you may not be able to close it, okay? Because the spreads are going to widen like crazy, given the fact that earnings are happening later. So it's either you do it soon and you exit for a $144 profit, or you wait and you may end up with 173, okay? In my mind, again, based on my trading style, I just like to leave these things, do the things, okay? Also, by the way, be careful which type of broker you're using. Like, for example, let's say you're using TradeStation. Well, if you end up making 173, you are going to have to subtract $30, because they're going to charge you $14.95 for exercise and assignment. So 14.95, let's call it $15 twice is $30. $30 minus 173, it's basically what you already have. So then I would say just close it, okay? Now, if you have a broker that does not charge for assignment or exercise, then, based on my trading style, I'm just going to leave it alone. But that, is up to you. I guess you understand the pros and the cons of the trade, okay? Please let me know in the chat box, as I'm moving to the next trade, PayPal. Let me know if all is clear when it comes to Amazon. I will just bring the chart just so we see the chart, daily chart here. Okay, you can see Amazon is currently here. Okay, that's where Amazon is. Again, it doesn't matter where it ends up because we locked in already that minimum $73 of profit. Okay, so if all is clear, all is confirmed, just give me a quick all good, all okay, something like that. That would certainly help on my end. Okay, next trade I'm going to start reviewing is PayPal, and then we also have Autodesk. So PayPal is a trade that completes tomorrow. Okay, if we look at the P&L of this trade, so we are right here. Currently, we are making $100. If you were to close it manually, if we leave it to expiration, which is tomorrow, we will make $133. There is still risk on this trade. Okay, we didn't do anything to remove the risk, so we're still in an iron condor that technically has risk. Okay, but again, the expiration is tomorrow, and based on probabilities, we are supposed. Give me a moment. I don't have the coin in the right place. I'm like, this is not possible. Okay, I have the coin in a prior date. Here we go. So this is where we're at. So based on probabilities, okay, tomorrow we should end up the lowest at 85 or something like that, the highest at 94. And this is indeed within our purple area. And even if you rolled, if you remember, I was talking about the rolls last week. So if you rolled the calls from the upper side all the way to this location, okay, which did I do it? 110. No, I did not do it. Okay, I did not do it. I still got the 110, 115, which is up there. Okay, but anyway, so if you did roll it, still, the probability cone, is crossing over right here, not 93. So, it doesn't look like this trade is going to be problematic at all. Now, of course, we've seen it before that maybe you have a gap up on the open, like this gap here, right? A huge gap. So then, of course, that would hurt the trade. Okay, so again, to me, this is something to leave alone, but at the same time, because we don't have any sort of protection, it is something that I would look closely, and especially today. Okay, today, as we are approaching the close, if by any chance PayPal, which the climate of the S&P is blue, right? So if PayPal was to continue moving in the direction of the S&P climate, which is up, and was to come a bit higher, and instead of making $97, you were to make, I don't know, like 120, something like that. So maybe it's worth it to just close the trade and get out. Okay. Now, having said that, may not be very easy to close in certain cases, zero bid on the call side because it's very far away. So maybe you only close the put side, you don't close the call side. Something of that sort could certainly be evaluated. I would leave it to your common sense. Take a look at it, towards the end of today, and some action tomorrow at the open. And if any, I would just leave it alone, which is probably the right thing to do, definitely based on probabilities. Just giving you a few choices in case some of you attending the session are a bit in the conservative side. Okay, so this is what's to be done with PayPal. Nothing. Trade is looking very good. It's looking like we're gonna end up with a profit. Okay, and then the next one to observe is Autodesk. And please give me some feedback as well when it comes to PayPal on the chat box. Is it all okay? Any question? Please let me know. And here we have Autodesk, which we started last week on the 20th of October. This is exactly 1 week ago. And this is a double calendar. Okay, this is a double calendar. And if we look at this trade, we look at the risk graph. Okay, this trade is producing $147 of profit. This is really unexpected. I mean, it's not like it's unexpected, but it's unexpected that it's happening so fast. That to me is unexpected. So why is that happening? Okay, and let me move here. One sec. Here we go. So certainly since the last week on the 20, it looked like implied volatility went down by a little bit. Okay, so why is that stock profiting? Well, the only reason that stock is profiting is that it moved to where one of our short strikes is. This is why we have some profit accumulated in this particular strategy. So if you look at the risk graph for Autodesk, we are getting very close to this peak. Okay, at 215, and because we're getting very close to this peak, that is why we have this increase on profitability. Okay, so also given the skew on this particular options chain when we build the trade, notice that the peak above is significantly higher than the peak below. So if the same thing happened, but instead of going higher, we went lower, we will be showing a profit here that maybe that will be a profit of, I don't know, $40. So instead, we got $137 of profit, which is, quite significant. So good beginning of the trade. That's nice in the sense that we're going to collect a decent amount of profits from the call side as we do the roll. So this is great. But again, like everything in life, it has pros and cons, because if this then comes back down, we may lose in the next roll. And also now when we do the call roll, we should get limited amount. Okay, good news is that Autodesk is a $200 stock, so we should be able to get something to continue and massage the trade. Okay, so not very happy to see volatility dropped a little bit from the last week. I was expecting it to go higher, but hey, what happened to the VIX? The VIX went down from the 30s to the 27 mark. So I'm not surprised. It's not like something is wrong with the trade. Actually, everything is kind of like working more or less normally. The only, surprise is that, because of the skew, the call side is showing so much more profitability in no time, $114 for the first week into a double calendar spread. It's quite a lot, I would say. Okay, but anyway, not a complaint about that. So just sharing. So anyway, so let's take a look at the roles. To do the roles with Autodesk, we're going to look at the front week and the next week, which is October 28 and 20 and on November 4. We're going to look at one strike. We are not interested in the at the money strike. We are interested in the 215 and the 190. Okay, so 215 and 190, those are the strikes that are relevant to us. And with those strikes highlighted on the screen, let's start with the 215. So the 215 on the front week has a theta of 111. 111 times 2 days is more than 125, which is the midpoint between the bid and the ask. So in other words, it's nonsense. It cannot be. It's a distorted Greek. So it's time to roll. So let's roll the put. So Autodesk, we identify the put, the call, which is a 215. I said the put, sorry. We roll the call. So the 215 call that expires tomorrow on the 28th, we create a rolling order so we can move it from 215 to 215, from 28 to 4, and that is going to bring in $3.25 of credit, which are additional to the credit already collected in the prior week. We just got filled at 328, and therefore I'm going to go back to top. I'm going to get back to the risk graph with Autodesk. I'm going to compare spread and create a primary, edit the primary, so I can add that variation on the call, where the call is now November 4. Okay, the call is now November 4, and let me bring a calculator. And we just added $3.28 to the initial 1.27 that we already had. Okay. 1.27 we already had. So this is equivalent to having 455. So if I do that, this is what we now have. Okay, we have a trade that looks like the orange graph. Okay, it's a trade that now has changed its risk profile, going from $1,178 of risk to be $850. So lots of reduction of risk in 1 week only, and we still have time to go, right, all the way to wait a moment. Yes, November 25. Correct. Yes, November 25. So we have many more weeks to do the same thing I just did right now. Okay. So now what about the call side? So back to the option chain. So when looking at the option chain, oh, I'm sorry, I said the call side, I meant the put side. So with the put side, if we look at the front month, okay, theta is 43 cents, but we cannot make 43 cents because there is not even a bid. So in other words, we need to roll. Okay, so if we roll, we're gonna roll for the 190 call expiring in November 4. So we are rolling now the put side, October 28. So we can make it November 4. And that should bring in 65 cents additional to what we have. So the trade is in. Okay, so it should be less liquidity and that strike because it's far out of the money. And therefore, the simulation here, it's giving it more time to get filled. Okay, because I don't want to spend time, and please don't do this at home. I'm just going to shoot for less. Hopefully I get filled faster. Okay, so again, the simulation is simulating lack of liquidity because the strike is out of the money. So again, I'm just going to use no patience, which is not what you want to do, but I'm doing it so we have more time for other trades. 55, okay, so it's not happening. And by the way, the reason why it's not happening is because we saw it here, right? So no bid. Okay, so major lack of liquidity on that 190 strike. Again, if you had done the roll before, maybe the day before, 2 days ago, which probably the Greeks started being distorted at that time, being that strike so far out of the money. So certainly that would have been a wise move, and you will not have the problem that I am having on my end. Okay, so I'm just gonna go crazy here, and please do not do that, because this is gonna be truly crazy. I'm gonna use a market order just so hopefully I get the feel, but please never do that, because the slippage we get would be unbelievable. Here with the simulation is looking like not even with the market order I'm getting filled, so I guess I'm gonna have to be patient. And anyway, just to keep progressing in the session so we don't wait. So we saw that in theory I was going to get 65 cents, I think it was. So what I'm going to do is my October 28 put, I'm going to move it to November 4. And to that 145, I'm going to add 65 cents. Okay. And that would make it 210 if I am not mistaken. So if I do that and I click OK, that would happen the moment I get filled. So then my new risk profile looks like that, is the orange one. Is wider. I'm still in a profitable zone. It's all good. It's all beautiful. But now my risk has been reduced all the way to 785. Okay. So again, this is the massaging of the trades that we do every week when dealing with double calendars on the way to have them become double diagonals on the last week. Okay. So that's it. The trade is here. I have not been filled, but I guess you are with me. I'm just trying to save time for the session so we have a bit more time to trade today. Cool. So all done with those review and management of trades, and now it's time to look for new market opportunities. I need your feedback, please, on the chat box. How is it going? Let me know how is it going. And while you're doing that, I'm going to take a sip of water, and we're going to start setting up the matrix for directional trading so we can find opportunities to become buyers. Thank you so much. Thank you, Jeff. Thank you, Mark. Good. So let's begin. I'm going to start with all symbols of stocks, which of course I'm going to change that later on. And when it comes to finding stocks, so the first thing I would like to do is find stocks that are in a long-term uptrend. Okay, now I'm not going to find any of those. Okay, I'm already going to tell you that, because again, the S&P has been falling, so this is going to be extremely difficult to find. But anyway, I just want to start, because it's been a long time we have not done directional trading. I want to go from a position where I don't find opportunities to I tweak and tweak and tweak until I find opportunities that make sense. So you see the process, so you can replicate this process by yourself. I'm also importing my penny increment options list. When it comes to strength, we don't want neutrality. This is what I look for, daily and weekly neutrality. I look for that when doing non-directional trading, but today I am directional. We are looking for earnings to be at least 30 days from now, so we have time to reach our targets. And because we are looking for directional opportunities, okay, in a perfect world, I would like the weekly climate to be confirmed early, and I would like the daily climate to be confirmed early and near to the EMA. Okay, so if I scan, I got nothing. Okay, and there are many reasons why I got nothing. Okay, first of all, weekly climates to be up. Okay, even if let me uncheck all other conditions I had. Okay, let me uncheck everything, even the climate by itself. Climates, okay, that are in the weekly are up. This is the whole list. Okay, what you see on the screen, out of hundreds of stocks, these are the only stocks. So this is already making it difficult, right? It's a very demanding parameter, given the fact that the S&P has been going down. Okay, that's a very demanding parameter. So in a day like now, when I mean a day, I don't mean a day, in a period, maybe it's better to say, in a cycle like now, where the S&P has been dropping the whole 2022, even though the climate we saw earlier that is now showing real signs of trying to go up. Maybe, I don't know, Santa Claus rally is coming, whatever. the market will tell us. I don't want to act as a forecaster. It's not our job. We are traders. Our job is to take risk and manage it with odds in our favor. It's not to forecast anything. So I don't want to do that. But if that's gonna happen, okay, certainly I want to participate of that move. And if I am being so demanding of my stocks to be already in a weekly early climate to the upside where the S&P is barely moving up, so I'm demanding a lot. Now, this is a good demand to have, because if I happen to be right and the S&P is going to push and those stocks are already in an up climate, that means those stocks are real strong, and actually these may be the stocks pulling the market up. So then these stocks may really spike up all the way. So it's great to start from here, but don't be surprised if later you see me uncheck that, because I may not get enough opportunities. Okay. Now, second comment is, I'm going to go back to the stock filters. Okay, and these are comments that are important to keep in your mind, given the current market condition. Again, the cycle in which we are, where the S&P has been going down for the whole 2022, and this may be the moment when it turns around and you're trying to catch valid candidates for that. So with that in mind, for sure, I would love to see those stocks not only to have a climate up on the weekly time frame, but also I would like to see those stocks to be already strong. Now, when I do that, now I'm only left with 4. So of course, if I add any other conditions, such as volatility, being low, or the daily climate also to be something, that's it. Next thing you know, 0 opportunities. My list is too small. Notice if I remove the climate condition, okay, if I remove the climate condition, okay, my list is just as small. In other words, what's the problem? The problem is that I don't have sectors that are moving up yet. And by the way, this is something that you can also see visually when looking at the group rotation tool and you enable long-term. Notice how everything is red. Like everything is red. So because everything is red, when you filter out, it's going to be very difficult, okay? Only certain industry inside some of those groups may show a little bit of blue. Those that are coming out like this, just very few are blue. That's why we got 4 candidates, but the majority are not, right? So in other words, the filtering condition, which is limiting me the most here, is not the weekly climate. It's the sector, okay? It's the sector. But I don't want to give, I'm okay to give up on the climate, because the climate is representative of each stock separately, but the groups represent the overall grouping, the overall industry. And I don't want to give up on that, because as we said millions of times in prior sessions, stocks are fragile. And that sounds terrible, but and stocks are fantastic to trade, to be honest, especially with options. But what I mean by fragile is that they are very, very, very easily manipulated by any external force. So the sector falls, good stocks will go down. Let's say you're looking at stocks like, let's say Google, and then next thing you know, Apple is falling down. Next thing you know, there is a contagious effect, and because Apple is going down, Google is going down, even though maybe Google is doing better than Apple, or maybe Apple is doing better than Google, or vice versa, or whatever that is. But there is this contagious effect, and that's why I'm saying stocks are fragile. So I don't want to give up on the sector and the group, because if the group is in my favor when I'm planning my trade, that increases the odds that those stocks will do better. That's why, by the way, we do the market analysis starting with the S&P, because if you trade in the direction of the S&P, you have higher odds for whatever trade you do to work in your direction. But on top of that, if we add the group to the mix, it's even higher probability. Okay, so of course, there are never guarantees, but definitely probabilities is something that we want. So I don't want to give up on the group rotation, on the group strength, but I only got 4, so that's not workable. So what else can I do? Well, then something I could do is, instead of relying on the long-term trend, which is a weekly time frame trend, maybe I want to rely on a daily trend. And if I do that, since the S&P has been going up for multiple days, we may have more candidates that on a daily time frame are showing strength to the upside. So this is now better. Okay, this is now something that I welcome more because the list is longer, and at the same time, we are not fully giving up on this. Okay. So I'm gonna start working on that. We had cases in the past, and this I'm not gonna use it today, but I'm just gonna review it just in case the market was to have another dip, and a few weeks from now you find yourself looking for trades. So something that we have done in the past when the midterm was down, the long term was down, the long term was down, and we would not find anything, was to look for rotations, right? And look for stocks that in the last 10 days and the last 5 days have rotated to the upside. So this will typically bring a list which is even longer. Okay. This may bring a list which is even longer. So that's not a bad idea. Okay. But the fact that it has rotated up, okay, it has rotated up, may not mean that you are in a strong situation. It just means that it went from red to blue. It doesn't mean it's deep in the blue or anything like that. So again, when looking for stability, because you want to allow the stock to move up and down and vibrate a little bit in the context of picking up direction. So I would say that relying on strong up is going to be a better choice. And again, only in cases where you don't have an established strength in the daily or the weekly time frame, then you would then want to play with this rotation tool, as I have done in past sessions when the market was falling harder and the S&P was not showing anything too significant yet. Anyway, with all of this said, that's a long explanation, but I want to give you tools so you can replicate this by yourself. So with that longer list, if I now re-enable the weekly thing, okay, what do we have now? Well, we have a little bit of a longer list. I'm not too impressed, okay? And as I said before, don't be surprised if I decide to give up on the weekly. The one I certainly cannot give up on is the daily climate, okay? To be either early or sensible. Sensible is fine to the upside. And if I do that, what do I get? I only get 2. So that's the problem. So, it looks like I'm going to give up on the weekly, okay? And that way my list is a little longer, okay? So this is a list I would be comfortable looking at trading, okay? And of course, do you have millions? No. Why? Because again, we are relying on the sectors, and because the S&P has been down for the whole 2022, not all sectors have recovered yet, and that's why the list is short. But these are the best candidates, and to be honest, this is a good timing in the market for us to be daring, and the reason why is because if you catch it, that's it. Is the whole new wave on the way up, like the long-term wave. That's what you're going to approach. Okay, so today you're going to see me plan on the entries in a way that is going to be different of certain other things you have seen me done before. Okay, because of this potential opportunity where this may be the bottom of 2022 into the new year, and 2023 be a strong year to the upside, which may not be the case. But if that was to be the case, I want to position myself and get ready to catch proper trades, in this sense. So coming back to you, but I want to take a look at the chat box. So let me see. You did not take the Autodesk trade. I get you, Mark. It's okay. Joanne, I check the calendar, Monday 10:30, and the plan will be to work on Ninja Trader. Wonderful, Joanne. No worries. Thank you, Joanne, for that comment on the trade management on the Amazon trade. Thank you. Wonderful, perfect, great. So now, one more parameter I would like to add, which, again, I'm not gonna necessarily look for it now, but it would be ideal, is to be near the 9 EMA. If you are near the 9 EMA, which I have none, that's really good for us to have the minimum risk as possible in this trade with a very close to entry situation. But again, in this case, I want to be, how do I call it? I want to be daring, but skeptical at the same time. I'm not sure if there is a word for that. You guys tell me on the chat box. Maybe there is a better word. What I mean by that is that, look, we have done the S&P analysis. The blue line is above the gray. The S&P is in an up climate. We have done all of those type of analysis, correct? So it's time to go for it. And today I'm making more time to talk about being directional, but at the same time, the market has been very violent to the downside in 2022. And if you look at the SPY, and instead of looking at it in a daily time frame, you look at it in a weekly time frame. So the climate seems to be changing. Okay, that's the other reason why this is a very good time, because if the climate changes, okay, you can be in a at least 7-week climate to the upside. So these may be the beginning of 2023 and beyond. So it's a very interesting time to start thinking long term. But at the same time, it may continue going down. Okay, it may continue going down before it stabilizes it. Okay, so I want to be daring but skeptical at the same time, meaning that I want to allow myself for some extra room for the market to keep going lower, okay, in case that's the case, before I get stock put to me, okay? And we have addressed this type of setups before. Let me pick one, for example. I'm gonna pick, for example, BK. Okay, so we have looked at trades of this sort in the past, and we have looked at things of that sort, right? So looking at, this is a daily time frame, 58% probability. This is good. So we have done things of that sort before, isn't it? We have taken something like that. We've looked at those pivot points. We have projected those pivot points. We have looked at UFOs, and then we've been selling puts there, okay, and then buying calls in exchange. We've done that before, isn't it? But which is great for when the market is moving up and then has a severe correction, and then you get back on board and things of that sort. But in this case, my concern is, that on the weekly time frame, we have not had yet a confirmation, a full confirmed confirmation that says that that's it. We're in a new up climate on the weekly and the daily both. So in other words, we may have another powerful leg down. I would say it's unlikely, but it's still possible. And if that's the case, I don't want to be exposed to too much risk too soon. So how can I address this particular situation, right? So knowing that those 30 levels are valid, and by the way, I think that BK is probably one of the great stocks to do this kind of application, okay? And you will see why in a moment. I'll come back to BK. Let me get another stock first so you understand my point. For example, Costco. So if I look at Costco and I find a similar setup, okay, 50%. Okay, so if we look at Costco on the daily time frame, we look at those pivot points, right? And I project it here. Okay, there's a little bit of an overlap. So let's say you go with that. Okay, let's say you go with this level here at 433. So if I was to take Costco and I was to do, let me write it on the screen so you know what I mean, because we have done that in the past. If I was to sell 2 of the 230 put, and let's say buy 2 of the 425. Let's pretend the 425 exists, and I use that credit. These are 2 bull put spread, and I use that credit to buy a call, right? So we've done that in the past, isn't it? But what's the issue here? The issue here is that I am taking in $1,000 of risk, which in an up market where you have more evidence of many more sectors going up, the weekly time frame of the S&P going up. So I'm okay with that. And by the way, $1,000 could be a lot or a little depending on the account size. But my point is that it's not the case in this case. In this case, that the market goes below 425 and may keep going because we don't have all the sectors of the market showing strength yet, isn't it? So in that sense, I feel that this is just a bit too risky to put $1,000 of risk. And again, I'm just using that round number because it's a reference from prior trades. Again, I insist, $1,000 may be a lot or very little depending on the size of the account. But based on using other trades as a reference, putting $1,000 of risk in a market like what's happening now, I feel it's a bit on the risky side. So I would like to go back to BK, and now you will understand why. Look, if I was to try to do the same thing with BK, so what's the difference? That stock is 10 times cheaper. It's a $40 stock instead of a $400 stock. It's a $40 stock. So what I could do here is, instead of sell 2 puts, buy 2 puts, and use that credit to buy calls, which is what I just explained a moment ago, right? So instead of doing that, which for sure you could, and now, I mean, if we are looking at this pivot low and we are dealing with those, let's say 34, let's even say 35. So I'm pretty sure that you could do 35, 34. I would guess, I haven't checked the option chain, we will in a moment, but you may be able to do 35, 34, and therefore you would have $200 of risk, okay? You would have $200 of risk only versus $1,000 of risk. Why? Well, because the stock is cheaper. I guess this is obvious. It's not a mystery. It's well understood. But now, because the stock is cheaper, what is another possibility? And this is the one I would like to explore with you guys today. Well, the other possibility would be to sell the 35 put and in exchange buy a call. You're going to be like, what? Sell a cash secure put or sell a put naked? Yes, because if you get shares put to you at 35, the most you can lose is 35, right? Which is 35 times 100 is $3,500. But I mean, it's not like the stock is going to go to zero. So if you get the shares put to you, and let's say the stock drops to, 33, whatever, it's still the $200. It's still the $200 that you would be risking here. You could afford this play here because the stock is way cheaper, and therefore is also less volatile compared to a $400 stock. And therefore, this is a more interesting approach to me in the current market condition, right? Where if the market was to continue falling and crashing and going crazy to the downside, so that stock is already $35, so it's not like it's gonna go so much lower. Where a $400 stock may become $200, so you just lost so much of it, right? But the other thing is that, and I got 2 more things to add here, and you will see my point, because I'm trying to go one step at a time, but you will see my point. So if I do one naked put only without buying protective puts, the net amount of premium that I'm going to get is going to be so much more, meaning that now my call is going to be so much closer, meaning that my resulting delta is going to be way greater, which means that, assuming I'm right on this is a significant turning point in the market, this trade is going to perform like crazy. It's going to perform at a level which is really, really close to delta 100. So that's what I'm shooting for. I'm shooting for a great performance and looking to contain my risk by looking at security, which is less of a cost, if you wish. In this case, a $40 stock. Looking for an entry price point of 35. The other thing is, if I ever get the stock put to me, you're going to tell me, Jose, wait a moment, now I got shares. No, where you will not. Well, yes, you will get shares if they are put to you, but no, because we're going to convert that into either a synthetic or we're going to color it, and coloring the shares is the same as a bull call spread. So you would close the stock to buy a bull call spread. So we will talk about further managements where if you end up owning stock, it's just going to be temporarily until you convert the stock shares into another options play. So basically, I'm just attracted to collect a great level of premium. But there is one more thing. I want to make this better. Hopefully I can. But before I get there, you guys with me, would you mind to confirm what I'm trying to do here, which is to, instead of doing 2 bull put spreads and take this risk, I'm willing to do it with a cheaper security, but without the protective unit, given the fact that the security is lower price point already, and also given the fact that I plan to own that security only for a limited amount of time if it goes against me. Good. Thank you, Joanne. Thank you for that. So now, I got you. So I'm going to make this better. Okay, I'm going to make this better. I mean, the option chain needs to allow me to, but I'm going to make this better. So now, how am I going to make this better? Well, first of all, if price comes here, right? If price comes to 35, how long is it going to take to come to 35? I mean, probably the best way to calculate how long things takes in the options world is to use a strategy builder, and it is giving us an expected date of 12/26. Okay, 12/26. So it seems that using December options would be the way to go, which is good because earnings is happening in January. So perfect. So far, all looking good. So I'm going to look at December expiration options, December 16. Okay. And with December expiration date, with December expiration options here, I am looking at the 35 strike, which the 35 strike is supposed to bring in 35 cents. Okay. Now, here what happens. If I do this trade and I 25, actually, if I get the bid price and I sell that, I'm going to get 25. So if I sell this put and I get 25, with 25 cents, the most I can buy is the 50 call. Okay, that produces a 16 delta position. Okay, so that's the best he's gonna get if I do sell the put, buy the call. Okay, so what is an alternative? Okay, and notice how the option chain got 40, 35, and 40 and 35. 40 and 35. Yes, it's not going to work. It will not work, my friends. And it will not work because the strike price increments is $5. And given the fact that that stock is so cheap, it's not going to work. Let me see what happens with January. Yeah, still $5. And November? November is $1 a time. We need to do this with November, guys. Let's try November and see if November is going to work. Being a shorter expiration date, the problem is that, we may need to roll it, later in time. So let's say the stock starts moving higher and everything is working according to plan and we are making some money. So we may need to roll it. Okay, we may need to roll it to continue making more money if we believe the move is going to continue. Okay, so I would have preferred December, but it's not possible. So anyway, so with November, if I look at the 35 strike and I sell it, it's not going to work. It's not going to work. So BK is not a good candidate. Let me find another stock. Sorry for that, guys. Let me find another stock and you will see, because if I find what I need, this is going to be powerful. So we can look at Cienega. What about Coca-Cola? $59 stock. Okay, sounds good to me. So with Coca-Cola, we got 59%, 59, 59. Okay, good. Very good probabilities. So if I project from here, okay, so we are talking about that second speed bump. That second speed bump is 52. So with Coca-Cola, we are looking at 52 as an entry target. So let me do the whole thing again. So date to get to 52 would be February. So February, pretty okay, coinciding with earnings. Okay, I'm okay, I'll take it. So if we look at the option chain with Coca-Cola and we look at February, here we go. So we have 2.5 strike price dollars of strike price increment. Let's see if that's going to work or not. We said 52. There is no 52. It needs to be 52.5. So what if I sell the 52.5? So if I do it, I can sell the 52.5. Yeah, here is going to work, guys. I can do the 52.5. Okay. Okay. And in exchange for the 52.5, I can buy the 67.5 or 65, and sorry, like that, and that would be a $3 trade with a 41 delta. Okay, so much better. So this is one possibility. Okay, so let me write it down. So one possibility would be to buy the 65 call, and in order to do that, we are selling the 52.5 put. Okay, so we could do that. Okay, and that could work. Okay, now what is another approach to this? Okay, what is another approach? Well, another approach is the following. Another approach would be to instead, let me get a copy of the graph, so then I can compare and you will fully understand. This one, so right click, risk graph, cool. And now let me get back to here, and now we are going to select 52.5, but now instead of 1, I'm going to do 2. So 1 and 2. And then I'm going to buy the 55. Okay? And then I'm going to buy the 55. That generates a credit of 40. So notice what I'm doing. Let me write it down because this is indeed confusing, especially because you have not seen me do that before. So if I, instead of doing 52.5, what I do is buy the 55 put and sell the 52.5 put, but that's 2 of them, right? So I'm going to buy 1 of the 55, but I'm selling 2 of the 52.5. That's what I did here. Okay? Instead of sell 1, I'm selling 2, but then I'm buying 1 above. So what happens? Well, buy the 55 and sell 2 of the 52.5. This creates a credit. Now think about it. Back here for a moment, just so it's less confusing. Sorry guys, I need to sneeze. Hopefully you didn't hear that. So if I get rid of the 65 call and you compare that, let's talk about the worst case scenario first. Oh, I just hit backwards. Okay, so let's compare these two. The one on the left, selling the 52.5 put, the one on the right, buying the 55 and selling 2 of the 55.5. So what happens here? Worst case scenario is the stock plummets, gets to 52.5, is expiration date, and you get shares assigned. If you get shares assigned for this, how many shares are those? Well, it would be 100 shares, right? So worst case, I get 100 shares of stock. Okay, that's the worst case. Okay. But what if you do the combination on the right? Well, if the stock drops all the way to 52.5, here you have 2 components, right? So you have the component, think about like this is 2 trades in parallel. So you have one of the 52.5 put that is the same as what we have on the left. But then to make these 2, so I have the other one here on the left, which comes with the 55 put. This, my friends, is a bear put spread. This is a bearish strategy, which we are entering out of the money. And if the stock was to reach 52.5, okay, let me simulate that. I mean, you should know it, isn't it? This is going to make you $500. Take a look. If I do 1-1, okay, so buy the 55, sell the 52.5, okay, so if I graph it, and the stock drops to 52.5, you are making their maximum profit, which is, I said $500. Is $250. Is the difference between strikes, 52.5 and 55. The difference between strike is $250 minus the premium paid, so that's $200. Okay, so if the stock drops all the way to your entry, you're gonna make $200 to be assigned on the other put. right? So in other words, you're gonna be assigned on this put, but for you to be assigned on this put, you're gonna make $200 on this side. Here on the left, you get assigned on the put, you keep the premium, but you don't get to make $200. Here you get to make $200, and because you have to pay the 55, you have a little bit less premium, but you still have $200 more than the case on the left. Correct? So I am mitigating my risk to the downside by doing this. This still creates a credit. This still creates a credit, which is 40 cents. $39. And with that, I could buy the 67.5. 52. 1, 2, and 55. So I could buy the 67.5 call, right, with that credit, and basically I would be paying net for $3. So compare the risk graphs. If I get, you know what, let me float it, and that way I can present this better. So if I do the first trade, let me bring it to the screen. First trade is on the left. So the first trade is made of sell the 52 put, 52.5 put, and buy the 65 call. And I guess this is understood. If the stock goes up, you're going to start making money, and that's it. If it goes down, nothing happens. You stay flat. If you get to 52.5, it's assigned to you. Now you own stock, so you have the risk of stock, and then we will need to act on that. But what happens on the right? Well, on the right, you have the same graph. You have the same graph. If the stock gets all the way to 52.5, you're flat. But notice that below 55, actually you start making money. And of course, then if it keeps falling down, so then, you know, now you have a problem. Below 50, you have a problem. But notice how now your break even is 50, where here your break even here is technically 52.5. So in other words, I am giving myself an opportunity to make some profit if the stock falls, and I am giving myself a greater cushion that allows me to be wrong by another extra $2.5 by doing this. I'm not sure this is the best explanation I ever done in the room. I apologize for that. I could have done it better, I'm sure. But basically, now, visually speaking, maybe you see my point. Maybe I should have started with the visual graph so you understand where I was going, okay? But basically, I am building a trade where if I'm right and the market goes, I'm going to start profiting. And if I'm wrong and it goes down, because the down cycle is not over yet, so I'm giving this trade an opportunity to profit a bit if it keeps falling, okay? And if I end up being assigned, I'm still creating some sort of greater amount of wiggle room that allows me to be wrong by a greater amount, all the way to 50, instead of here, when I get to 52.5, that's it, I own stock, and now if it keeps falling, I'm losing 1-to-1 under 52.5. Okay, so this is an application that for the current market condition, I believe it's probably wise. It's daring but skeptical. Maybe the word is conservative. I'm not sure. You guys tell me which word you prefer to use, but hopefully this is making sense. Let me know what you think on the chat box, guys. I need to know that you are with me, and we are just reaching the top of the hour too. So I guess it's time to execute this trade, and we're gonna have to go. But let me know. Joanne, understanding. Mark, this is sensible. Joanne, no, we did not. Oh, you know what? I missed you. I don't know when you texted that. I'm not sure what is it that I said for you to say that. So if you could explain it to me, I'd love to know. Be brave when others are fearful. Indeed. Got it. I would have never thought of this trade. Options give you options, my friends. Options give you options. It's just a beautiful thing, guys. Okay. Yeah. And plus, worst case, now you own Coca-Cola, which later we're gonna convert into an options trade if we end up with shares. And by the way, I would say the probability of Coca-Cola to go bankrupt and become zero is quite low. So again, always managing risk. That's why I went for a lower price point stock, $60, right? So even if you get a sign on 100 shares, it's not like you got a sign on a $2,000 stock. So again, there is a little bit of a daring approach, but while we are being a bit daring, there is this risk management component on, hey, the various possibilities that this trade offer to be hurt less in case things go wrong. And if things go all the way to your assign, what you have been put to you, it's certainly something that is not too problematic. You have not been put poison into your account, right? So it's Coca-Cola shares. Oh, got you, Joanne. You didn't get the sneeze. So I guess I was fast enough with the mute button. Good. So let's do the trade. Okay, and by the way, I still did not get feed on Autodesk there. Anyway, that's the simulated accounts, the thing that happens. So we are looking at February expiration, February, and we are selling the 52.5, buying the 55, and buying the 57, 67.5. Call. Correct? Was that the trade? So yeah, but yeah, of course, but this is not one, this is two. Okay, so selling to the 52, buying the 55, and then 67.5. Yes, correct. This is the trade. So see a trade basically done for a $3 debit. Okay, if you are patient, I guess this trade you could get it for free. Free doesn't mean no risk. Okay, we know the risk of the trade. If it goes below 50, you are losing 1-to-1, like if you own the stock. Okay, but it needs to go below 50. The stock is currently trading at 59 something, I believe, right? 59.63, right? Okay, so I have the trade there waiting to get filled. I'm just gonna make it market just so we get it filled so we can go. Please don't do that. Be patient. Just try to get it for free. I guess with a little patience you make it that. Okay. I just got it at 8. Okay. Got it. Perfect. That's it. I got it. So I will document this. Okay, and we will discuss this trade in future sessions. But yeah, that's the trade that we got today at this price. Okay, that's where we entered with Coca-Cola, and the prices that we got. Edit spread. I will check. I will have a last look at the chat box in case there are questions. Okay, so if you have questions, that would be the time to type them. So 67.5, we got 45 cents. 52.5, we got 81 cents. And 125 for the 55 put. So if we click OK, this is the $8 I pay for this trade. Okay, so that's what we got, and I'm just gonna copy this position to the clipboard, and from there to the positions inside top. So we have it here, and we can work on this in the future. Cool. So this is one of those trades where if the stock rally is nice, that's what you are expecting and that's what you want, and thank you very much. But if the stock falls very hard, like if I'm not mistaken with the math, by like 20% or something like that, and you get it put to you, it's also a happy moment. It's not a big problem. Anyway, my friends, we're done for today. No feedback on the chat box, so I guess all is good. As always, thank you for joining me. It's always a pleasure. These 1 hour sessions go so fast. I hope you guys have fun with Joanne in the meeting room. Ninja traders there with Joanne. I love that. So you guys have fun. You guys take care. Trade well, and anything you need, for sure, shoot a message. Use the help page, the questions page on the website. Anything, we're here to help. So make sure you count on us. Take care, everybody. Bye-bye.